if I could invite everyone to take a seat. We will start this session, which is entitled Sovereign Default. My name is Simon Johnson, and I have the great privilege and honor of being joined today by three great experts on various dimensions of both the general issue of sovereign default and I think what will be one of the specific topics today, which is the exact situation in Europe, within the Eurozone particularly, and what is likely to happen with regard to sovereign debt in that set of countries as we move forward. On my right is Carmen Reinhart from the Peterson Institute for International Economics. On her right is Ken Singleton from Stanford University. On his right, in a change of the program, is Peter Boone from the London School of Economics. Marty Feldstein, unfortunately, is not able to join us today. We will run this discussion, run the panel very much as a discussion. It will be extremely interactive between the participants here, and we will have time for your questions at the end. Due to constraints on the panelists' time, we have a hard stop at 12 noon, but I hope we'll have at least half an hour for questions. When the time comes for questions, and I will remind you of this, you need to come. We are being webcast, so only ask a question if you'd like it to be broadcast to the world. And we ask you to, we have one handheld microphone, we'll ask you to come up to the front and ask the question facing this camera using the microphone. The question will then be handled by the panel in the usual fashion. So, to begin, I will ask Carmen, then Ken, then Peter some fairly straightforward questions just to really get the ball rolling. And the first question is, I think, the most obvious question and perhaps the most dramatic question of the moment, which is whether each of the panelists thinks that we will have sovereign default in Europe in the next 12 to 18 months. So are we now looking at a situation of imminent sovereign default, presumably among countries that were previously thought to be very good credit risks? And I turn first on that question to Carmen.
He said there were basic questions, general. The answer is yes. I'm not so sure on the imminent. We've been playing a long game of delay. The crisis in Greece has been drawn out. Now we're several years into it. Nothing happened swiftly. But let me quantify briefly why the answer to are there going to be defaults, or more precisely restructurings. Why the answer is yes. It's not a seat of the pants answer. It's arithmetic. Not even math, arithmetic. Debt to GDP ratios are at levels of which austerity and growth are not likely to do the trick entirely. And so restructuring of debts are in the cards, not just for Greece. I would add Portugal. Despite the very strong fiscal performance, I would add Ireland. And in the question of Italy and Spain is the question of, are they too big to fail? But certainly the debt dynamics. And in those debt dynamics, let me emphasize two factors, and I'll stop there. Number one, we are not just dealing with public debt numbers that look abnormally large. We are dealing with public debt numbers and private debt numbers. When you combine the two, and the dividing line between what is public debt and what is private debt is blurred. If you look at the aggregate public plus private debt numbers, and I speak with having looked at this debt data going back hundreds of years, have not seen debt ratios such as the ones we confront now. Right after World War II, we had a lot of high debt, but it was strictly public debt. Now we have public and we have private. Furthermore, we have hidden debts, and I'll stop there. Hidden, what do I mean by hidden? Well, if we knew what they were, they wouldn't be hidden. But the point being that the negative surprise element, Spain, which we thought more or less had its act together, has uncovered fiscal deficits that are much larger than what was previously thought. We have a lot of below-the-line arrears, meaning countries are financing themselves in Portugal, in Greece, in Spain, in Italy through arrears, simply not paying their suppliers, not paying rents, not paying employees. And we have this at every level of government. So orders of magnitudes and hidden debts, for me the answer is yes. More restructurings, but it's a slow process. I don't think imminent, around the corner, has been the hallmark of this episode.
Okay. Thank you, Carmen. Ken, will there be imminent, soon defaults in Europe?
My views are actually quite similar to Carmen's, and so rather than repeating much of what she said, let me throw in a few additional perspectives on it. We are certainly going to see some form of restructuring with regard to the Greek debt, and I think there are a number of interesting questions still outstanding about what form that will take. What will be the percentage write-down? There are a lot of numbers floating around even within the last few days now of caps on the present value losses of Greek bondholders to something around 60%. And I think it's an interesting question as to whether that will be enough. It's also a quite interesting question about whether that will be called a default. I can't imagine how rating agencies could not view that in any other way than a material consequence for bondholders of a 60% write-down in the present value, on a present value basis of the value of those bonds, and whether or not they're able to proceed in a way that avoids a credit event from a CDS perspective is an interesting question. And that question unravels into additional interesting questions about the current risk profile of the banking system in Europe and what the consequences are of that risk profile, in particular the role of CDS as a hedge for the exposures of those banks. And maybe that's something we'll come back and talk about. I think the other thing that I would put on the table for us to hopefully all come back and talk about as this unfolds is a restructuring is going to take place at some time, and I think a very interesting question is, why is it taking us so long to get there? And obviously part of this is political, but I think implicit, if not explicit, in a lot of the arguments coming out of central bankers in Europe is that they have an economic model in mind as well, one that seems to go along the lines that if we move to a restructuring of one country, for example, Greece, there will be immediate, significant, and catastrophic contagion to other countries. And so I'll put on the table the question of what economic model is sustaining that view as contrasted with all the political issues, which I certainly recognize and understand a little bit anyway. And then the final point I guess I would make at this early stage is that as we roam around the other European countries, I also agree with much of what Carmen said. I think there are some very big differences between Spain and Italy in terms of the nature of the exposures that you see in those two countries. They're both big, but Italy certainly has some very large government deficits that it needs to be worrying about. Spain, probably less so, in spite of recent revelations. And Spain's problems are probably more concentrated in the banking sector. And there the ECB has stepped up efforts to provide some degree of flexibility in insurance. And so as we roll forward from here, we might see a widening gap between circumstances in Italy versus circumstances in Spain, or at least how they're perceived. And that will be interesting to watch.
Thank you. Peter Boone, what do you think we're on the brink of imminent sovereign defaults in Europe?
Okay, thank you. It's a little bit boring because I agree with yes to the answers there, but I'll talk about some areas where I would disagree or what I think is happening. I think one thing that people don't understand in Europe, analyzing the problem often, is that this is not about liquidity and it's not about contagion in a simple way. I think the best way to think about what's going on is imagine you're a pension fund in Italy and you're backing up long-term liabilities with a government bond, an Italian government bond. Or maybe you're in Amsterdam or somewhere else and doing the same thing. And all of a sudden you see Greece default. And it is a default, absolutely, what's happening now, of course. And when you see Greece default, you've learned something. You've learned that this bond that you used to think was sacrosanct and was priced when you bought it like it was sacrosanct is no longer sacrosanct. And Greece, we were all told, was not going to default until early this spring when the Germans in particular, and Mr. Schäuble, made some comments about how they might have to default. And that's what's happened in Italy, is that people have realized the bond that you hold is a bond which depends upon the willingness of Germany, Merkel, of Schäuble, the willingness of the French, the willingness of the Greeks, the willingness of everybody to behave in a particular way, or else it causes all sorts of ramifications for yourself. And so that 1.9 trillion euro bond market has moved from a bond market which was really safe and thought of as a long-term safe asset to something which depends upon the actions and the goodwill and the willingness to bail out, et cetera, of all sorts of different entities across Europe. And it's just a very different bond. And when you have that bond, you have to have a very big risk premium because it's an unusual instrument. And you cannot support 1.9 trillion euros of those bonds easily in a market without a large risk premium. But then if you have that large risk premium, Italy can't afford it, right, obviously. So with 120% of GDP in debt, if you add, say, a 5% risk premium into that debt, that's where we are today, 7% yield on the Italian bonds, they are clearly bankrupt, right? They cannot afford that politically to run the surpluses necessary to bring the debt down. And so I can't see, given the structure today of the Eurozone, how Italy survives, right? And the pricing in the market is exactly that. The 7% interest rate tells us Italy won't be able to make it. Now, the argument you could make, I think, counter to that is that all we need is the ECB to step in. And people raise and raise the numbers about how much we need, and this is typical of big defaults and crises. But we've gone from a little bit for Greece to a couple trillion euros, at least, from the ECB to bail it out. And a couple trillion euros may well be right. You'd have to buy maybe half the Italian bonds gradually. The IMF very interestingly said recently that Greece may need $500 billion of financing if things go in their bad case scenario. Well, if Greece needs $500 billion up till 2020, and you're bailing out Italy, and you're bailing out Portugal, and you're bailing out Ireland, the numbers add up to very big numbers. Now, one thing I disagree on that was said was, Carmen, you mentioned that you thought the budget in Ireland was improving. Ireland's running a budget deficit this year of 12.5% of GNP. Sorry, the end of last year. This year it's going to be a little over 10. These are very soft targets. They haven't had a fiscal adjustment necessary to bring the debt down at all, right? Debt is accumulating. And so these countries, it's the potential bailout that the ECB would have to do to solve the problem, as people describe, is growing, and it's a very big number. And it seems very difficult. So I think the end result of this is quite scary. Either we get defaults, which could be very disorderly, or we get the ECB issuing so much money that it has lost control of monetary policy. And then we rely on trust of citizens within Europe to stick with the euro. Because if they decide they don't like the euro anymore, it will all collapse in inflation. And we're on this knife edge between the two. But I definitely think we have to have defaults. But the bigger risk is that it turns out to be defaults with collapse of confidence in the euro.
So we started on an upbeat note. To try and put this European situation, which I agree with the panelists is really quite dire, try and put it in a broader perspective, the next question is, what's the right reference point for thinking about what has happened in Europe and what's going to happen in Europe? What are the historical experiences? What are the other country reference points that we should be using? Is this like some version of an emerging market crisis? Is it more similar to something what we saw after World War I, for example? Do we have to go back even further in history? Or perhaps history is no guide at all, and other experiences are irrelevant because what we're seeing here is so different. And let me start this round by asking Ken. What are the right reference points? How should we benchmark this? empirically. And the next question will be about theory. So, but let's talk about empirical reference points on this round.
So I'm probably the least of the historians on this panel, and so we might have things in reverse order. But let me say a few words about it. I think actually it's very hard to think about a fully comparable situation in history, where for a lot of the reasons that we were just talking about, and particularly the collective action issue here of a group of countries that share a currency but are not part of a fiscal union, and all of the political and economic dynamics that are going to play out from that. If we think about recent sovereign defaults, be it in Latin America or in going back 20-some years to the Russian default and other cases like that. The circumstances are very different. The set of issues in play were very different. And so I don't think there's anything really quite comparable. And I think that's actually going to play in a lot to how we think about this theoretically. I would say that one thing we do see looking back to Latin America, to the Asian crisis, to Russian default, et cetera, are big differences in the reactions of markets globally to sovereign restructuring or default, depending on the degree of overall liquidity in the system. And we've just come off, or in the midst of, a very significant weakening of the economies globally. Certainly, central banks are flooding markets with liquidity, and so one could imagine a good outcome like the Argentinian default relative to a bad outcome like the Russian default in the sense of the consequences for the global economy. And I think some of the significant differences between those two cases have to do with the economic circumstances at the time of those defaults and the amount of liquidity that was available in the system, and also aspects of surprise. But I think here this case is different because of the circumstances within Europe, and actually also, frankly, partly because of the way the European regulators and central banks have handled things so far by dragging this out so long, and I think ultimately probably amplifying the problems.
I spot a potential constructive disagreement here. He did say the buzzwords, "this time is different," and Carmen flinched. But before I come on to Carmen...
Carmen smiled.
Carmen smiled, sorry, Carmen smiled. Let me ask Peter the same question on reference points, other country experiences we should be drawing on or comparing and contrasting with. Then I'll come to Carmen.
Right. I think there's many differences at the smaller level when you look down at it. I think the very big difference here, or the very big common problem here, is we end up, we all have in advanced economies, but also in emerging markets, and we've seen it more in emerging markets, governments who make promises that often they can't afford, or that over time they can't afford. And our politics in that sense appear to be short-term, in that we build up liabilities, which are often very implicit, very opaque. They become very big, and then they rear their heads, and we all realize, wow, that is quite a big liability, right? And then we run, and that's when the financial collapse happens. And in Europe, I mean, the creation of the Eurozone, in retrospect, when we look back on it, was a big thing, right? And those little clauses which said there would be no bailouts didn't seem like much at the time, but there goes the lender of last resort. And the lender of last resort left. We got the first couple defaults. And now we're seeing what I think is a very typical crisis. It starts off people saying, well, this is all liquidity, and if we just bailed it out, it would be okay. And then it gets bigger and bigger and bigger, and the numbers get bigger and bigger and bigger, and either it gets stopped or it doesn't, and the more it lasts and the longer it goes, the less likely it's going to be to get stopped. And then we see interest rates rising, economies moving into recession. We see politicians who come in like Monti and Papademos and others, very vigorous at the start, but then they get beaten down by the opposition over time, and there's a fight over who's going to pay the costs to get out of this. And those costs are hard to share or divide up in any society, and it takes a long time. And we end up with a collapse, and at some point it's so painful it stops. I think the simple analogy in many ways to what's going on is the breakup of the Soviet Union, because the dynamics of the currency breakup were similar in the sense that there were central banks in each of the republics. They were all able to issue money, and some of them issued a lot more money than others as it was falling apart. You had huge transfers going on across the republics and the central banks as there was capital flight. And then they gave up on the currency, of course, and it ended in a big inflation at that time. But we're seeing all those transfers going on at the moment in the European Union, in the Eurozone. It's just at the moment we haven't lost confidence in the currency. But in many other ways, it's very similar.
Carmen, if this time is not different, why not?
You know, I think and here I'm going to disagree with Ken, I think we get swept away by, oh yes, there's, you know, it's Europe, it's not Latin America, or there's a currency union. But if you strip down the pattern of the crisis, it's like an illness, you know, an illness that hits a 15-year-old is not going to manifest itself the same way as an illness that hits an 80-year-old. But the same illness has common symptoms, and that common symptom, you know, very much along the lines of what Peter said, is it's the over-leveraging. We built up a lot of debt, and at some point, those debts become unsustainable, and a series, first, Ken and I wrote a paper called From Financial Crash to Debt Crisis. And it details really to the hilt the pattern that we've seen in Europe. You start out with a big buildup in private debt. This is a time where everybody's a genius. You know, your asset prices are booming. Private debts continue to mount. You borrow from abroad, large current account deficits. The problem of private debts turns into a banking crisis. The banking crisis results in a massive recession that hits government finances. Revenues implode, plus the government begins to take on all the private debt. And then you go from a financial crisis to a fiscal crisis, which is where we are now. And the question of, in this historic pattern, which we're repeating very beautifully in a negative sense, obviously, what is next? And the next, I would say, as a benchmark, we have to do a combination of the 1930s and the post-World War II period, and I'll be explicit. This is not, emerging markets do not have the collective resources that Europe has. So the crisis in Argentina showed the same pattern. You know, the private sector borrowed, you then saw a sovereign crisis, you then got the default, but they were an isolated case at the time. The Russian default did have international repercussions that were much, much greater, but it was still confined to emerging markets. This is a big problem collectively that we really haven't seen since the 30s. To me, the right benchmark starts out with the 30s. It's an advanced economy problem. I would point out that irrespective of whatever is said, everyone defaulted in one way or another or restructured in the 1930s. Okay? In terms of, and this is not a fact that is often highlighted, but nobody in Europe, not the UK, not France, not Belgium, nobody paid their World War I debts to the United States. In 1931, there was a moratorium, only Finland paid. Only Finland. There were domestic forcible conversions in Australia and New Zealand, which are countries that you don't think of as having had any kind of default history. There were. The US defaulted, reneged on the gold clause. It was a default because I am telling you these treasury bonds are payable in gold. And then I come in April of 33 and tell you, no, guess what? They're not payable in gold, they're payable in dollars, but the gold content of the dollar has fallen by more than 30%. That's a default. And I would like to leave as parallels a combination of the 30s and the post-World War II. Where is it different from the 30s? Where it's importantly different is that we have more collaboration internationally within Europe and across the advanced economies than in the 30s. There is much more collaboration. There's a greater effort and willingness to go to great lengths to avoid some of the output collapses, as much as we've already had output collapses, okay? So it's, but to avoid the magnitude and duration of the output collapses we saw in the 30s. And this is where the experience of the post-war, and I'll conclude here, the experience of the immediate post-World War II kicks in. In addition to explicit restructurings, I think we're going to see, you guessed it, a lot of financial repression. What is financial repression? Financial repression is something that we have reserved those terms for, oh no, China has financial repression, India has financial. The emerging markets had financial repression in the 80s. Financial repression was the norm in the advanced economies. In the 40s, 50s, 60s, we had very tightly, knit relationship between government, central banks, and financial markets. You had a lot of, a big hand of government in financial markets. Interest rates, international capital movements were not very, very far from what we got accustomed to in the 80s and 90s. I think we are seeing, out of necessity, government step back in. Banks, pension funds are captive audiences, and those government debts are going to be crammed down the pension funds. The banks already, you see this, this is not sort of a hypothetical, this is already happening. And it's driven by necessity. It's driven by the necessity of governments to try to keep interest costs at bay. So I think there is, and I agree, there always is something different in each crisis. And one thing that I would highlight that is very different in this crisis is that it is the largest peacetime expansion in debt, public and private. So the debt levels that we have are really, this time is different, the magnitude. But I think that the response will involve the inflation story, I think is part of the financial repression. But in the 50s and 60s, and I'll stop here, in the 50s and 60s, you didn't have the runaway inflation because the government and the financial regulators had every hand in the pie in determining interest rates. So you got negative real interest rates consistently, okay? And what are negative real interest rates? They're a tax. They're a tax on the bondholder. Financial repression is nothing other than a tax. And so I think that, restructurings, financial repression, what is the last thing we've heard from Europe? Well, the ECB is not going to bail out the governments. It'll bail out the banks. But what are the banks going to do? They're going to buy government debt. Sure. So it's a nice circle. I'll stop there.
And that brings me exactly to the third question, which is about our theories of government debt. And I would actually, and I'd like to ask each of the panelists for their views on whether we have the right theories, whether these theories need to be updated or revised in some fashion, and particularly to press you on banking. If we're in a situation, as you seem to think, where previously so-called risk-free assets now have a substantial risk of default, or perhaps are already on the verge of default, and if the right historical comparison, as Carmen says, is the 1930s, where I would agree with her, I think the US did default on precisely the terms that she just laid out for you. How should we think about banks? How should we think about bank capital? How should we think about financial stability in that kind of framework, the relationship between the financial sector and the sovereign debt? But I leave it to the panelists to either take up that or to address something else in terms of, do we need to update and amend the theories that we have in our standard toolkit? Let me start this round with Peter, then Carmen, then Ken.
Okay. Let me start with, again, with Europe and then move on. In Europe, as Carmen said, every bank is being bailed out. So the Irish banks, which are some of the worst probably in Europe, Anglo-Irish is one very good example, a massively mismanaged bank with the complicity of the government and other people there. That bank is being bailed out by the ECB, and they're saying, absolutely, you must not default. You must not let it default. And that's the problem in Europe right now. Nothing is allowed to default. If the ECB had its way, you would never have let Greece default, and they would have printed money and hoped it went away as a liquidity problem. But there's a bigger issue here, and I think this goes back to your question, Simon, on the theory. Japan, to me, is a very interesting case. Here's a country that has a little over 200% of GDP in debt. The debt is growing very fast. They just passed a budget for next year, which looks like it will have around an 8% of GDP budget deficit. And they collect half of their spending, and the other half they collect by issuing new bonds. And they have to roll over 55% of GDP every year in bonds. That's worse than any country, of course, in the Eurozone. Italy has to roll over about 25% of GDP. So here's a country which is obviously relying on trust that it will never default, never have a problem. And the government is issuing all this debt and hoping it all keeps going. Underlying demographics are terrible, as you know. The working age population's fallen by 10% over the last 10 years. It's still in decline and will be. So the people who are going to have to repay this debt are the young people, and there are less and less of them. And then lastly, people who are saving in Japan, and the reason they can do this is they have a high savings rate. They put their money in the bank buys the bonds, or they put it in the pension company, and the pension company is forced to buy the bonds effectively. They put their money there expecting to get a real return in the future and get their money back, and the government takes the money and spends it, right? Spends that money and just builds up debt. It all goes out in current consumption of the government. So that country is walking towards a massive collapse. Europe has its problems. We've just seen big problems in the US, and we have big moral hazard problems given how much we bailed things out. And what are we going to rely on? Well, I'll go back to Europe. One discussion is we need to rely on more regulation. So we have new laws that are going to regulate cyclical budget deficits, define that, et cetera, all sorts of problems. They haven't really addressed yet bank supervision, but they will address it over time. Here in the United States, we've had the big buildup of moral hazard, and then we've got Dodd-Frank. Now, Dodd-Frank's very interesting because it says there will be no bailouts of very big banks. But I spoke with two former governors and one governor of the Fed over the last 4 months and asked them all, what happens if Bank of America gets in a lot of trouble? You're not allowed to bail it out anymore. And they said, don't worry, don't worry. The system will always find a way to bail them out. You don't have to worry, right? And so every country in the world has this problem that we have an ability now to issue a lot of debt, to create financial transactions which are opaque, to profit rudely from them. We have an ability to put a lot of debt onto our children, and we're all doing it. We're all doing it. And so my feeling is the problems we're observing are a part of a very bigger problem of modeling the politics of debt, how it is our societies create them, and how to get out of them. And let me end by saying I think where we go wrong in economics is that over the last 40 years, we've taught people that you can reduce volatility through policy. And the counterpart of reducing volatility is taking out risk, right? And the taking out of risk is being put more and more on the central banks and the government's balance sheets. It's not getting rid of the risk. It's just transferring it. And so we have reduced the volatility, but unfortunately, it's led people to feel they'll always get bailed out. And we can't regulate that. We're just, as a society, not capable of regulating these bailouts to keep them in a reasonable size. And we're all trying to bail out now madly because we know if we don't bail out, the thing will fall apart. And I think we've got to somehow go back and look at our economics and try to understand, maybe we have to accept bigger recessions, real bankruptcies, et cetera. And how do we do that? Because we're obviously not capable of doing it right yet.
Carmen, what's wrong with our theories?
Well, I would also start out by saying that we have a lot of forgetfulness in the profession. And if you actually go back to some of the work that was done in the 30s and 40s. And you read, for example, Harberler's Prosperity and Depression. It's very illuminating that they actually could understand and describe very well what is happening today. So I love to quote Madame Bertrand, who said, "There is nothing new, is just what is forgotten." She was Marie Antoinette's couturier, so she was referring to fashion, but the same thing applies to economics. On the modeling side, we have tended, and this I love to, this is on my co-author Ken, you know, the classic, one of the classic models, Bulow-Rogoff, which is indeed has been, you know, a benchmark to study sovereign default. And in models that followed from that class, default is treated as this big discrete event that a country defaults and then they're out of the financial market forever. Well, come on, we have serial default, you know, I mean, you know, just I always love to bring up the statistic that if you look at the probability of being in a state of default for Greece since independence in 1830, it is 48% of the time, okay? And this has been through several episodes of default. So markets forget, and the default is not a very once and for all discrete event. I think we also, some of the issues that you raised, Peter, I would like to see more modeling of episodes that the credit events are more blurred. And this gets into a very big black hole in theory, which is most of the literature, the theoretical literature on default, focuses on external debt, which is sort of an easy, you know, you default because you can't pay. You can't monetize external debt. It's not in your own currency. So you know, you either pay it or you don't pay it. But a lot of the big issues, and this is the Japan issue, is domestic debt, okay? It's domestic debt, and with domestic debt, you can maneuver things here and there. You can do financial repression. Why is Japan not in the same state as in Italy, despite the fact that their finances are far worse? They don't borrow from abroad. They don't have a current account deficit. They have a very financially repressed economy in which the debt is domestic. 95% of domestic debt, of Japanese debt, is domestically held. Okay, so, and these kinds of important restructuring mechanisms, because, you know, ultimately that means a haircut on domestic residents, are really, there's a dearth of modeling there that I think we are going to see more work on domestic debt. I think we are going to see more theoretical work on other forms of debt restructuring rather than the more discrete decision of there is payment or no payment. But I'll conclude because I found Peter's remarks on Japan very provocative. So, and I'd like to go back to the issue of financial repression. So the pillars of financial repression are you have a domestic, you create a domestic market that's a captive audience for your debt. Because that you have to worry less about rollover. And who has the biggest rollover when non-residents are holding the debt? Right? Because you can't do anything about that. Right? You can do a lot to your domestic residents, but you have less control as a government on foreign holders of debt. So Japan's been able to get this far, importantly because its debt is held domestically. Where has it failed abysmally in the financial repression scorecard? Well, financial repression, for it to be successful in liquidating debt, you have to generate inflation. You have to generate negative returns. So you get people to hold the debt at very low nominal interest rates. Then you generate sufficient inflation to generate negative interest rates, and you give them a haircut. This was, by the way, and I'm not talking about an emerging market, this is what the US did after World War II. This is what the UK did. Interest rates on treasuries were negative 50% of the time in the advanced economies between 1945 and 1980. Okay? Deposit interest rates on savings accounts, we're negative 62% of the time. So now if you ask yourself, why do people hold treasuries? Well, you did even worse if you held a bank deposit or a saving account. But the bottom line is this whole area of hidden debt restructurings is something that is very much outside the modeling sphere in the literature on default. And I covered this literature when I used to teach my international finance course. That was one of the areas where we spent a lot of time. You know, how do you really understand domestic default episodes, which are, you know, in the end, we have, I think, you know, this challenge that a lot of the benchmark assumptions that we use in modeling to simplify, such as the interest parity conditions, you know, are very difficult to match empirically. Let me stop there.
All right. Ken, how should we change our theories? Also, in the rotation of speakers, I haven't come to you for a while, so if there's other points that have come up, please jump on those and react.
I'm trying to absorb all of this. I think it's good to reflect at this time, actually, on almost to disagree with Carmen's disagreement with me. I think we're almost in complete agreement, and that her characterizations of the very broad brush features of financial and sovereign debt crises are certainly playing out in many dimensions here. But I also think that there are very large differences in this case with some of the prior cases that are really material for thinking about where we're going from here, and also ultimately, I suppose, on how we think about our economic models. We can capture some of the, at least in reduced form, and from an econometric perspective, we certainly can capture the fuzziness of default that my fellow panelists were mentioning. Default doesn't have to be perfectly predictable, doesn't have to be defined by some known boundary, et cetera. And we can capture that, we can model that. Indeed, we have done that. And there's a literature on modeling sovereign credit risk, for example, that has these features. And from that, you can back out the time variation in risk premiums, not only in prior to times of crisis, like going into the Russian default, for example, in some earlier work I've done. You can do it in the current crisis now with regard to all the European countries. And the IMF has a project going where they are, in fact, extracting risk premiums for all the European countries and looking to see what financial markets are saying relative to what one could infer from macro information like output growth and inflation and differences across countries. And it's intriguing and revealing. One of the things you see from that work is that there are big movements in risk premiums in these markets that apparently have a lot more to do with people's willingness to bear various kinds of risks rather than the inherent risks themselves. That is, whether the fundamental risks in some sense have changed or not. We see very big swings in risk premia that are related more to the financing costs of the big players who are trading in these markets than they are to the characteristics of the countries themselves specifically. And I think that's partly what we're seeing now with regard to the risk premiums that were mentioned earlier with regard to some of the southern European countries. But that's a big step from actually writing down structural models that would explain the strategic interactions that are going to be unfolding as we go forward from now. And I think to get to that, and this is work that obviously has been spurred on by the crisis and we're seeing a lot of right now, we need to do a much better job of building financial sectors into our models to have a serious financial sector rather than securities being sort of veils in a lot of the macro and international macro models that are out there. We need to deal a lot more with risk aversion in a lot of the models we work with. So many of the international models have been built up assuming risk-neutral players on both sides of transactions. And, but I think a lot of the strategic issues that are being played out now also need to be built into the models. With regard to the banks in particular, there's a lot of work going on how we should think about capital requirements and what capital levels should be. There are clearly huge subsidies out there related to deposit insurance and implicit guarantees. And it's probably reasonable to argue that capital is currently being, if not mispriced, prices are certainly being distorted by government policy around the world. And that's having has had a big effect over the last 15 or 20 years on both capital flows internationally and also the growth in the balance sheets of banking systems around the world. And there's a very active, lively debate, and in fact, I think reasonably well understood menu of the conceptual issues related to the frictions that that underlie arguments for why banks should be holding more capital and why we need regulatory revision. But we don't have a lot of numbers on that. And in some of those mechanisms and some of those theories might not ultimately be the right answer. So the debate goes on because a lot of it hasn't been quantified, or a lot of the quantification needs probably further development and refinement. But I think these are areas where the theory itself also needs to be better integrated with the macro side of the economy. And we're at early stages of work on this. I think there's a lot going on. But I think we're not going to be able to extract from the models that my fellow panelists have mentioned a clear vision yet, I think, on how to think about what's going to unfold in Europe.
I think Carmen has a brief clarification just on the
I just wanted to clarify that I agree very much. When I was talking also a lot about the theoretical models, I think in this area, especially in the area of modeling country risk, you know, early warnings, time-varying risk premia, I do think empirics is, you know, measurement is ahead of theory, in that the tackling of time-varying risk premia has been much more squarely addressed in the empirical literature than in the straight theoretical models, which is what I was referring to. Just that one clarification.
Now, I have, from my side, just one more question for the panelists, but it is a very big question, I should warn you. And just to anticipate, we will then turn to questions from the audience. For those who were not here at the beginning when I first made this announcement, if you want to make a question, we invite you to come down to the front. We'll give you a wireless microphone, and you speak towards that camera. This way the question will be picked up properly by the webcast. For those of you sitting at the back, therefore, you might want to edge a little bit towards the front while we're having the next 15-minute exchange. Here's my question. It's a serious question, and one that I grapple with both in academic context and in dealing with policymakers of various kinds in lots of different countries. If we think about the world now, any part of the world going forward, is it appropriate to continue to believe or to build models as if there is something called a risk-free asset? Carmen told you the United States defaulted in the 1930s. I agree with that, although we can have that discussion. We're talking about imminent default in some parts of Europe, perhaps not all parts. Is this a reasonable way to think about finance? A conceptual framework for thinking about risk? I think much of what we built in the past 50 years assumes there is sovereign debt somewhere that is essentially, or perhaps entirely, devoid of default risk. Do we really need to change that way of thinking about the world? And I'll go back to the original rotation through the speakers, Carmen, Ken, and Peter on that.
I think that's indeed a very big question. very often when I highlight worries about the long-term health of U.S. fiscal finances, the response that I get is, but Carmen, look where interest rates are in the U.S. Look how low interest rates are. And, you know, if you really believe that that is a market interest rate, so you need two things not to alleviate my concerns. You need to convince me of two things. Nobody's been successful at that end, let me forewarn you. Number one is that that is a market interest rate, a real market interest rate. Number two, that interest rates are a good predictor of financial crises. And I will deal, because this is very much related to the risk-free rate concept. Okay, right now, if you look, this is not a statement that is made lightly. If you take the flow of funds data, I have done this for the United States from 1945 to the present, and you look at the outstanding stock of Treasury debt, more than half of that debt is in the hands of official institutions, that is the Federal Reserve and foreign official central banks. This is not a market audience, okay? So, you know, the Central Bank of Chile or the Bank of China are not going to run out and engage in a sell-off of treasuries with the same motivation as would a private agent. Why? Because the reason they bought the treasuries in the first place had nothing to do with how attractive the treasury returns were. They bought the treasuries because they didn't want their currencies to appreciate. So, you know, the currencies, the purchases of treasuries were done for their own policy objectives, not because it was an attractive rate of return prospect. And so these interest rates that we now marvel, look how low they are. If you look from 1945 to the present, nowhere in that time frame has that much of a share of treasuries been held by official, non-market participants. So I really don't think this is a market rate that we're seeing. And I don't think we're going to see market rates for a long time. This is very much related to my remarks on financial repression. Secondly, are interest rates really, you know, if interest rates are really encapsulate this risk profile, are they good predictors of financial crises? Graciela Kaminsky and I, in my work with Kaminsky in the late 1990s, early 2000, we calibrated a lot of the predictive ability of various financial indicators and real economic indicators as well. Spreads do very poorly. Spreads are coincident indicators. Interest rates are low until they are not. Okay? This is actually very different if you look at equity prices and you look at not the, you know, equity prices have a lot of noise, we all know, you know, they predict, you know, what, 5 of the last 3 recessions or something like that. But, you know, equity prices, 12-month rate of change, you know, you see significant declines in rates of returns, negative rates of return on the eve of financial crisis. And on the eve, I mean in the 18 months before a financial crisis, be it a banking crisis, be it a sovereign default, or be it a currency crash. Interest rate spreads are incredibly noisy. So I don't know what a riskless, and I will conclude by saying that in the recent crisis, this second point that I've been making, that interest rates are not good predictors, should be fairly evident to anyone. Let's take a step back from Europe and talk about Iceland. Okay, And some of the statements that I make about interest rates can be made also about credit ratings. Okay? They're coincident indicators. They're not leading indicators. Iceland in the year 2000 had gross external debt, public plus private as a percent of GDP. It was not quite 100%. It was not really alarming. Current account was in surplus. It wasn't borrowing from the rest of the world. By 2006, the current account deficit was 26% of GDP. And the gross external debt as a percent of GDP was over 900%. It had the same credit rating. It was AAA in 2000, and it was still AAA in 2006. And if you looked actually at the spreads told you nothing. It didn't tell you that that country was marching towards a very severe financial crisis. And I use it as an illustration, but as I said, the work I did with Kaminsky was not a seat of the pants, was a very systematic look at multiple dimensions of the predictive ability of spread. So I really do, I'm very sympathetic to Simon's call for what is a risk-free rate. And first of all, what do rates more broadly? What do rates really tell us? And in that context, how do we extract a risk-free rate when we know that market has heavy-handed manipulation from the official sector?
Ken, is there now or will there be such a thing as a meaningful risk-free rate of interest?
Carmen has kindly given me the luxury of changing the question a little bit. Let me start with the question posed, and then let me also say a little bit about the second very interesting question that Carmen raised in parallel with it. I take a rather, if I can say it, financy view, I guess, to this issue, in that I've actually never thought there was a risk-free rate. Or we need to think about what we mean by a risk-free rate. I know what it means to think about a risk-free rate in a representative agent model where I write down their preferences, and I know their consumption streams, and I can think about the returns to loans that, say, pay off with certainty a unit of consumption at some point in the future. But if we start thinking about yields and interest rates within our financial system, we just need to broaden out what we might mean by a risk-free rate, even though it would be a hypothetical rather than something we probably would ever observe. For example, I've never viewed Treasury rates as risk-free rates. We tend to be preoccupied with them a lot in finance, in particular in our term structure modeling, but it's actually, I think, not the most natural market to focus on from a term structure perspective. I think much more natural is to focus on financing rates of large financial institutions, which takes you into the LIBOR markets, and swap rates is a much more natural way to think about a reference curve. And indeed, that's what financial institutions do when they build their term structure models, and they spread the Treasury to their reference curve. The Treasury is not their fundamental curve, and that's not how valuation is done within them in those institutions, because the Treasury market's not their financing rate. And we're seeing this right now. There's a lot built into the Treasury curve related to flight to quality, but more generally in these markets and in financial markets, part of the rates we see reflect a shadow cost of capital that financial institutions and other institutions have available to invest. So going back to my earlier remarks about why we see very large swings in sovereign spreads in response to sometimes very little changes in fundamentals of the countries themselves, it has a lot to do with people's willingness to allocate capital to that sector within the financial system. So you can go back in time, for example, there was a period, as I recall, it was like May 94 or thereabouts, when the Federal Reserve unexpectedly, well, actually when non-farm payrolls were released and they were unexpectedly positive, and people reacted to that thinking that the Federal Reserve was going to tighten monetary policy, and sovereign spreads around the world widened out dramatically. They just spiked across the board. And the reason was because people thought financing rates were going to go up for financial institutions, and everybody started unwinding their carry trades. And so we can see that's just one very concrete and anecdotal but real example of how people's willingness to commit capital and the shadow costs of these capitals show up in these rates around the world. And so we need to be thinking about these and maybe modeling these more as part of how we think about the determination of interest rates. With regard to how the rates relate to anticipation of crises, I think it is very difficult to use yields or spreads to predict crises. We do see, however, a pattern, and it's probably also the case that we see it more often than there are ultimately crises. But one of the things we often see are how tight risk premiums become prior to a crisis. Go back to the Russian case in the summer of 1998, for example. And if you backed out from the term structure of Russian bond yields, the implicit short-term interest rates going into the summer of 98, you would see that Russian bonds were trading through LIBOR. That is, it yields below dollar LIBOR. Dollar-denominated Russian bonds were trading below LIBOR. So people thought going into the summer of 98 that Russia looked a lot better than the US banking system. And of course, a few months later, we had chaos, and Russia ended up defaulting, not on its euro debt, but on domestically controlled dollar-denominated debt. If you look at the conundrum period in the United States going up around 2005, 6, 7, the Greenspan coin is an anomalous period. Risk premiums were incredibly low and tight in that period, well below what would be rationalized by the stage of the business cycle using standard macroeconomic conditioning variables. So something was going on in financial markets that led to very, very tight risk premiums going into this crisis as well. That was true throughout Europe at the same time. So I think something can be potentially learned from financial markets, or at least we can get signals that should lead us to ask questions about what's going on and how should we interpret what is going on, which may be different than saying we could predict with high degree of reliability whether there's going to be a crisis in any different circumstance.
Peter, is there such a thing as a risk-free rate of interest?
Okay, I'd like to start off by sort of agreeing with Ken that you know, the nature of something risk-free is a bit hard to define because everything has risk, but let me pose it a different way. Is there an asset we could save in and feel comfortable over 20 years? You get a return, right? Not a big return, but that you wouldn't lose a lot. And I'm afraid that's really hard to answer at the moment. And I think there's really two views out there of the world. And one of them would imply we're headed for a lot of trouble and volatility and nothing is safe. And the other that things are safe. And the first one, or the one that things are safe, argues that the world is going along okay. We need to make adjustments at the margin. And for example, if we have better regulation, smarter regulation, more capital in banks, et cetera, they'll be better managed, they'll run well, and we'll have a smooth economic system over the next 20 years. And I think the alternative, which I find attractive empirically at least, looking across countries, is that we have created in our legal system and our financial systems and with our politicians the opportunity to transfer liabilities around. And that's an extremely tempting thing to do when you get into power or when you're near to power, or it draws you into power, it sucks you into it. And if you're allowed to transfer around financial assets and liabilities, you can create a lot of wealth for some groups, of course, and take away from others. And if you do that in a way like I was saying Japan seems to be doing, where you build up large amounts of debt that are a burden on future generations which can't be represented, then of course it is a system that will eventually blow itself up. And it's a bit odd. I would think at times that spreads are not much, much higher than they are currently, because these risks really, really stand out. But let me go to this point on the alternative, smart regulation. You know, the view is that, yeah, we have moral hazard, we bail things out. The way we control it is through regulation. And that seems to me to not be working. We've had Basel I, we've had Basel II, we're now on to Basel III. I think it was last year, Mr. Bernanke gave a talk here where he said it was very important to have smart regulation, that was how to help us get out of the crisis. Well, that may be right, but why is it we didn't have it with Basel II and Basel I? And an alternative model is just to say that we will always find, as humans, ways to get around the regulations and things that face us. And that's Goodhart's law. There are many different laws in economics that people talk about that have that same general equilibrium result, which is if you regulate and control one area, as long as we have this system where you can transfer liabilities and things, I'll find another way to get around that. And so, as Carmen said, the numbers now are big. Credit divided by GDP around the world is very big in most advanced economies. It's something that just keeps growing up. In Europe, we're at a more immediate problem, which is every single bank needs to be bailed out. And the Bruegel Institute recently came out with a very interesting paper where they said, we want to think about how do we solve Europe's problem for the long run. And they said, first of all, it's very clear we can't have bailouts. Politically, that just won't work in our economy. The Germans won't allow it. Politically, we can't transfer across zones over the long term. So we have to create a safe system. And so they said, well, to create a safe system, why don't we make sovereign debt levels at safe levels? And then Reinhart and Rogoff came up and they said, you know, if we have a system where you don't have a lender of last resort, then probably debt to GDP levels have to be less than 60%. So they then worked out what would the surpluses need to be across all the countries in Europe to get debt to GDP levels down to 60%. And the answer was far too big to imagine. You just couldn't do it, right? So then they said, well, we can't have safe sovereigns. But what about banks? Why don't we do as follows? We can have sovereigns go bankrupt or restructure if necessary. But with the banks, we'll have safe banks, and then we'll keep the financial system stable, and we'll just have a little more volatility from the sovereign. But then they said, actually, that never works, of course, because who's going to buy the government debt? And how will banks survive if sovereigns fail? Banks couldn't hold sovereign debt. Then you couldn't have these big sovereign debt levels, and so everybody would enter into default very quickly. So they said, you can't have safe banks. Well, then what do we have to do? Well, we have to go back and have some sort of bailout system, which we can't really have, but we have to have that with fiscal transfers. And they said much better regulation, much better regulation. And we come back everywhere around the world. The final answer is we need our leadership to provide better regulation. But they haven't, right? And very smart people worked on Basel II, and they didn't get it right. But they probably did get it right. It was just very, very smart people with huge incentives found ways around it. And those people still exist, of course. Many of us are here, presumably, right? So it's a system, I think you can really go back and I'll say, as I said at the start, you could have two theories, you know, two views on this. One is that smart regulation, working on the nuts and bolts, will keep it going and it will be safe. And the other is that we have in our societies just a system which is going to blow itself up because we will exploit all the opportunities to do things that unfortunately lead to growth of credit, lead to transfer of resources with that, but eventually mean it has to fail because the people who are supposed to pay it back just won't or can't eventually. And if you believe in the latter, of course, there's definitely no risk-free asset. There'll be a lot of volatility in all assets. Thank you.
Okay, thank you. So now we have about half an hour for questions from the floor, and I see Anat Admati. Anat, you have to come to the front, and you have to face the camera. So there's a small ordeal attached to being able to ask a question here. And if you would pose it as a question, and we'll decide who's going to take it from the back.
Well, I do have a couple comments very quick. To what default versus other things you might think about, the words are insolvency, which is not quite default, and distress. These are the unhealthy pre-default situations. You can kick the can, etc. With respect to riskless asset, I have one for everybody coming from corporate finance. The first dollar that Apple borrows, that's a risk-free asset. Because the private debt that Carmen was talking about is concentrated in the banking area, not in the rest of the economy. So I do want to go to that and to smart regulation and say the regulation has not been smart, and among other things, it has allowed banks to lend too much to sovereign and to households because of things like risk weights and things like that. They have distorted the incentives of banks. If Peter's saying that we cannot regulate, then we're really in bad shape. So I'm hoping we can actually do better than that. But risk weights would be the one thing to start tackling. So I wanted your perspective on risk weights and their role and the difference between private debt of banks and why the discipline that limits the debt of other private corporations doesn't seem to work for banks.
Okay, so if I understand, the question is about risk weights, which is obviously a fundamental approach to thinking about banks and bank capital. And is there something deeply wrong with the risk weights pushing banks to hold banks to hold too much sovereign debt, or just too much debt, to have too little capital, too much debt? How much of this should we lay at the door of the risk weighting system? Ken. Or anyone else who wants to take it. You look least interested in the question, so I thought I'd put it.
Just wake me up. Thank you.
More perplexed, perhaps.
Well, I'm going to. People are going to think this was rigged because some people may know Anat has some opinions on this, and I'm a colleague of Anat's, and I have some opinions too, and we don't completely agree. But I think I'm going to start by passing to my right here, and then let it circle back to me on this question.
Wow.
Peter.
Is that allowed?
Once per match.
Yeah, there's no regulation.
It's a bailout.
Yeah, no, I actually, risk-free. So why has the sovereign got a zero weighting? Why has it got a zero weighting? I think we all know why they've got a zero weighting, right? I think we all fully understand why they've got a zero weighting. And that's my point, frankly. There's a general equilibrium result, which is, people who have the power and the ability will adjust things in their favor. And we can create, and I totally agree, if you look at the regulation, lots of dumb things were in the regulation, right? And certainly the people who did it were very smart, right? I'm sure they were as smart as all the rest of us when they sat around and worked on those regulations. And we're all doing the same thing now for Basel III, and good luck, right? Good luck. But I'm pretty confident there'll be ways to get around whatever regulation are imposed. And so if we want to make regulation work, we have to think about how the whole political system will work in order to restrict the types of things we want to restrict. And I would be very confident that if we set up a lot of good rules in the regulation with capital requirements, all the rest, it won't make much difference.
Carmen, you want to take it?
Couple of observations. One is on discipline. I don't think we can make blanket statements about the lack of discipline in borrowing is limited to banks. And this is an important issue in the question. Who does the guarantee cover? Well, the banks are clearly under the umbrella usually of the you will be bailed out. But I will point out the issue that I raised at the beginning of the blur, there is a blur between public and private debt. This is not limited to the debt of banks. What did Korea do in 1997? The first thing the government announced is that all corporate debt, and we had a massive surge in private corporate borrowing, not just the banks, was guaranteed. So yeah, I mean, to the extent that, and the auto companies in the US. So to the extent that I would say the overborrowing problem is very much importantly tied to who's getting the guarantees, whether these are explicit or implicit. On the issue of regulation, look, I think Simon Johnson put a question of, is there a riskless asset? And I really should have answered that with another question, which is over what time horizon? Because there are certain periods. Regulation for better or worse, we thought we had outgrown it, and it was unfashionable, and all the regulation that came into being after the Depression, okay, which was an outgrowth of financial crisis. You know, it was geared towards crisis prevention. You know, it did not want to replicate having the banks investing in the equity market. And so, you know, a lot of that stuff which we thought was dated, we got rid of. So my view is, I think there will be, you know, I'm not gloom and doom about regulation, but I think it has a life cycle. And then this time is different. Then we become more smart than our predecessors. They are, you know, arcane rules. They don't apply to us. The world has changed, and we ditch the rules, and we repeat the same mistakes. I have, you know, the idea that regulation can prevent crises indefinitely, I think, is just not in the cards. It can prevent crises for a while. And that while, importantly, has to do with human nature and how long your memory of the last crisis lasts. So
this time is not different, but it may be worse. Ken, did you want to come back on this? Or
I will say a few things, yes. And I agree that, and I feel that we could have done better, and we can do better with regard to regulations. There are always going to be compromises. Where we've come down in our compromises has been far from where we have needed to be, I believe. But I think there's another dimension of this that might be worth mentioning at this point, and that is, in addition to the types of regulations like risk weights and other very tangible things like that we've been discussing, there's a lot of scope for discussion about disclosure. And there's a tremendous amount of opacity in our financial system. And our regulators and central banks around the world seem to be operating under a model where preserving that opacity is in the best interests of the financial system. And I'm not exactly sure what the reasoning is, but it must be something along the lines of we're largely facing a liquidity problem, not a solvency problem. And if we just keep the information from everybody so markets don't get too riled up, things will eventually get better, this liquidity problem will go away, and we'll come back to normal. And I think that's a rather heroic assumption on many dimensions. The first being that less information is better for all of us, and second, that it's just a liquidity problem and not something deeper than that. And it is astounding to me how little we know right now about the balance sheets of our own banks, and not to mention the major banks in Europe, other than, I think, a widespread informal belief that most of them must be near insolvent. And yet European politicians and indeed central bankers are arguing that it's merely a liquidity problem in Europe and not a solvency problem. And it's nice that the new managing director of the IMF was a little bit bolder in her assessment of things. So I think markets can potentially function better in terms of some of the disciplining and monitoring issues that were implicit in our earlier discussions a few minutes ago about the role of debt and debt holders with better information. And our regulatory policy framework is itself partly to blame for the limited amount of information we have about the financial system right now. And I think that's unfortunate.
Okay, another question from the floor. Either way, please step up and try to look at the camera when you ask your question.
I will turn my shoulder. I think I'd rather be in the middle of it and also address the panelists. I wanted to go back to what has been said before about the risk of default, maybe 18 months down the road in Europe. And to what Carmen was saying about the worrying fact that 50% of treasury debt is in the hands of government-like institutions. Well, in a way, we've seen data today. The unemployment rate went down again. Retail sales did better. The American economy is functioning. And it never went quite near to the type of crisis that we are seeing in Europe. So the question is, isn't that a good thing in a way, to try to build a bridge so that things in the economy can work better? And don't you think that maybe it would be a good idea for Europe to act very quickly and for Germany to allow a more aggressive intervention in buying the sovereign debt by the European Central Bank and in creating either a Eurobond or a fund so that things can, on one hand, get better on the fiscal side with the austerity measures, but on the other hand, there will be more calm in the market. Otherwise, the risk is disaster. So, this is specifically for Carmen, but for everybody, of course, would that be better? Will it happen?
Thank you. Very, very good question. The question, I take it, is from Italy. May I make? Yes. It was just a lucky guess. Carmen, what's wrong in this situation with providing what might be characterized as a U.S.-style bailout not for big banks in this instance, but as you said, Italy might be too big to fail. Maybe think of Italy as a big financial institution on the brink of failure. What's wrong with that way of thinking about how to address the European situation?
I didn't say there was anything wrong. I didn't say there was anything wrong. When I brought up the issue of financial repression means also that you are willing to tolerate somewhat higher recurring inflation so that a highly controlled financial system, with a central bank that is quite pliant. Yes, the term is fiscal dominance, okay? That's the correct term. The fiscal dominance, I think, is going to be part of the solution. And the reason I think it is part of the solution, but not the only way to go, is that the orders of magnitude of the debt problem, you really, debt write-downs are still part of that answer. So it's not you either have a central bank that's very accommodative, that buys a lot of debt, or you go the route of restructuring. I think in several cases, definitely the case of Greece, Portugal, and Ireland, I think both things are required. It's not an either-or. I do think that a credible, and this is very interesting, right? Because we have forgotten, we became accustomed to central banks that had an objective of inflation. And in the case of the ECB, that's extremely clear. Inflation was the objective, period. Now that objective is being weighed in by, do you care about inflation or do you care about financial stability? Okay? So inflation says you really hold the line and you don't let the central bank buy all that government debt. Financial stability says, well, the central bank's got to do what it's got to do because the orders of magnitude of the debt involved are sufficiently large that we need help from every corner. And if part of the answer is that, we got more controlled interest rates with a higher rate of inflation than what we've been accustomed to, well, that's a tax. Inflation is a tax. Negative real rates are a tax on all the. The statement that I made, which was a factual statement about official creditors, official holders being the really big players in the treasury market, wasn't a criticism, it was a statement of fact. I think in the case of Europe, it has been very, very counterproductive to have a central bank playing hardball when, you know, right now, if you weigh the risks of a financial meltdown, of severe economic contraction, and of inflation, the weights that you would assign probably to a financial meltdown and severe economic contraction are pretty high relative to the inflation. So I just wanted to clarify that. I think, will it happen? The last part of your question.
Sorry, will or should?
Should it? Okay, I think should, yes.
You dealt with that.
You know, I think the financial repression, it's a tax. It's not a, it's a distortionary tax, but it's, you know, you're weighing one unattractive alternative versus other unattractive alternatives. It's not. The austerity measures are no bargain. And again, this is not in lieu of austerity. These are, you need help from every corner because, as I keep highlighting, the orders of magnitude of the debt problem, the bank debt plus the government debt are really, this time it's different, are of historic proportions. Will it happen? I think we're more likely to see it in a very grudging, gradual, de facto rather than de jure. Are we going to get announcements that, you know, the ECB is going to provide support explicitly for government bond markets? I don't think we're going to get statements to that, and we're not going to get the Financial Repression Act of 2012. You know, what we are likely to see is more of a de facto rather than de jure outcome, in which, you know, to save face, the ECB is not helping the governments, mind you, it is helping the banks. But who are the banks helping? The banks are buying government debt in increasing amounts, because we have, you know, if you look at bank portfolios right now, they've become more, this is the return of home bias, okay? They're holding less external assets and buying more of the domestic debt. This is a closure of, or a reduction of that globalization trend that we had. And so the concrete answer is, I think it will happen out of necessity, grudgingly, but always look for actions rather than words. It's going to be done more de facto and probably with too much of a delay than as a more de jure, more proactive manner as the Fed has done.
Okay, Ken or Peter, you want to comment on, should the Germans just get over it and help out the Italians, Peter?
Sure, I'll make a quick one. I actually think the ECB is acting like the old Banca d'Italia. You know, they're fighting with the fiscal authorities, and they're trying to get them to tighten up and do more. And the way they're doing it is keeping interest rates high and not buying too many bonds, but buying some. And I think it's actually probably the worst of the possible solutions, because the two alternatives are either to go ahead and admit there'll be more defaults rather than do it begrudgingly. And that's what is very few people seem to want at the moment, but maybe some Germans want it and others. Or the alternative is what Mr. Trichet wanted all along, which was don't let anyone default, bail them all out, but have a lot tighter fiscal programs than they currently have. And I think the problem for the ECB is that IMF number I quoted a minute ago. The IMF said Greece may need €500 billion until 2020 under their bad scenario. €500 billion. If Greece needs €500 billion, what is the bad scenario for Italy, Spain, Portugal, Ireland? It's a big number, right? So you need much bigger fiscal adjustment now in order to get more comfort, I think, at the ECB to make, you know, these type of promises. But they need to make, I think, the Trichet, you know, type view. There needs to be somehow a way of promising that you're backing up this debt so you get the risk premium down due to the lack of lender of last resort. But you know, when you watch the way Mr. Berlusconi behaved when they first started buying bonds, it obviously upset people a lot. And so I agree completely with Carmen that they'll continue this begrudging way of doing it. Real interest rates will stay high, and that's going to cause quite a deep recession in Italy, and it's unclear how that will unfold.
I was in a panel discussion recently where somebody made the point that Mexico was greatly helped in 1994, 1995 by a loan from the United States that was about $45–50 billion. And the discussion then became, what is the equivalent type of assistance that would work in Europe, for example, between the Europeans, through the European Central Bank? And a very distinguished person, okay, it was Paul Volcker, at the end of this discussion said that he knew the number that was needed to save Europe, and the number was 2 trillion. And I asked him, is that 2 trillion euros or dollars? And he thought about that, and he said euros. But I'm not even sure from this discussion if and from what we've seen in the past 6 months, whether 2 trillion euros is sufficient. If you really want to back up these promises, if you really want to reinforce the existing system with all its problems and just hold your nose and go in for one more round, this is an extraordinary escalation of the kind of backstop that you're calling on. Increasingly, I think, in the sense of the panel I get from the panel is, we're looking to the monetary authority to backstop the fiscal authorities that are in very serious trouble. Now, what are the consequences of providing that kind of backstop? What does that do for the credibility of the central bank? That's fallen somewhat outside the purview of our discussion last hour and a half, but those have got to be serious concerns. Any other questions on the floor? Yes, can you make your way?
If sovereign defaults are quite likely, what are the scenarios where this damage can be contained, or does this lead inevitably to the decay of the monetary union?
And what's the damage to the United States? I would add to that. So monetary, if it's going to happen, how do you contain the damage both within Europe and around the world? Let me start with Peter. But you can hand this one to Ken. I think you're entitled.
Yeah, I'll hand it over to Ken. Okay, I myself don't believe you can. I believe if Italy defaults, it will just be an absolute mess. And I think the reason is more on the policy. I mean, first, I think economists, we'd all sit down, we'd say we could write down a way you could default and reduce the pain and everything else. But those things don't really work in practice very well, because in the run-up to it, you get all sorts of activities going on in financial markets that cause things to be volatile. But even more so here, you've got 17 nations and all the central banks and everything. They've got to get around a table, and they've got to agree Italy will have a restructuring of its debt. And the Irish will put their hand up right away, and then the Greeks, of course, will raise it second for a second time, and the Portuguese. And it'll just be a mess to try to work out how to do all this. So the political reaction, I'm sure, will just stay the same as it is. Nobody will default. Nobody will default until it's forced upon them. And that's, by definition, disorderly.
Ken?
Well, I guess I would putting it maybe just a little bit differently. We are right now in the middle of a default, of a restructuring. I mean, there's no other way to view Greece, I think, in those negotiations. So I think an optimistic scenario is that, as Carmen says, that maybe somewhat enthusiastically and in veiled ways, the ECB continues to work through the banking system to help governments as needed, as well as the banking system. That the U.S. economy does, in fact, start to improve and strengthen. It does appear that in recent surveys that Northern European banks are relaxing somewhat their lending standards in the face of improving conditions in other parts of the world, and that growth in the U.S. and perhaps in Asia, as well as some nudging along banks' willingness to start lending within Europe, starts to show some economic growth, which gives some relief to the fiscal side of Europe. And over time, slowly and gradually, they pull out of this. And I'm not looking for a year. I would think multiple years. At least to the point where it becomes a lot more feasible for countries to start adjusting their fiscal positions. But if that scenario doesn't unplay, and in particular, I think if they're forced to continue down this path of austerity and domestic civil unrest, then I think one can't be too optimistic about near term in Europe. That is the likelihood of a very major meltdown becomes much higher. But there is a relatively orderly, optimistic path that might work to come through this, but lots of things have to fall into place. Obviously, they're hoping for it in the face of tremendous political difficulties in terms of sorting it out, a collective action.
Carmen.
I don't equate default with the breakdown of the euro. Okay, I think the Europeans, the Germans, will go to great lengths to avoid a meltdown. And a meltdown scenario, I mean, there's degrees of meltdown, okay? Can we avoid default? I don't think so. I think we're already there. I think it will continue. I don't think it will stop in Greece. But does that mean that I think the next step follows, which is the euro going to necessarily dissolve? I don't think so. I think there is a huge vested interest in keeping the euro alive, north and south in Europe. In Greece, we've had protests for every measure imaginable and over every decision imaginable. And yet, amidst all those protests, the sentiment of staying within the euro has remained incredibly high, as far as I know. I think in Germany, let us be very candid. What would the German Deutschmark be doing now? Look at the Swiss. I mean, and do you really want 60% appreciation in a short period of time? So there are pragmatic reasons, but I think there are also important social and political reasons. So all the scenario that I envisage is like Ken. It's a multi-year muddling through. Sort of muddling through is a good, I think they will need austerity in any scenario with restructurings, with financial repression. Come on, the transaction tax is yet another form of financial repression. You need resources from every angle that you can. In a very, you have a huge debt overhang and you need the resources. But I think that it will be in this long, protracted muddling through, let's kick the can down the road. But in the interim, look, the pension funds and the banks are holding, when these governments have auctions now, those auctions are staged. Those are not market rates. The buying at those auctions is orchestrated. So there are already subsidies, and this interconnection between the financial sector and government and the ECB. What does it mean for the U.S.? Well, I wouldn't extrapolate from the fourth quarter of the U.S. I simply would not extrapolate from the fourth quarter of the U.S. I think the term muddling through is also applicable to the U.S. Our debts are growing by leaps and bounds. We have several states, including non-trivial ones like California, that are in, a situation where unless we become, an Asian tiger and grow incredibly rapidly for the next few years, the fiscal problems that we face are going to be with us. And I think that it will entail fiscal adjustment. At some conjuncture, we'll have to face the tune. So I think what concerns me about the spillover from Europe to the U.S., apart from sort of you know, it poses a bleak scenario for external trade, right? Because you're really only relying on emerging markets. But apart from that, what scares me is what we don't know. Because usually the killer contagion episodes, and this is something that Carlos Veg, Graciela Kaminsky, and I wrote about for the Journal of Economic Perspective many years ago, a killer element is surprise. What if a little mutual fund goes belly up because of its exposure to Europe? The trigger element that could have, even if it's a tiny one, could be very great because, you know, Thailand was a small drop in a very large ocean, and look at the ripple effects it had. So I think what I'm saying is, that's not my baseline, but I think the odds of something like that happening are much greater the worse the outcome in Europe is. But I think the muddling through is the term that I would use to characterize the advanced economies for different reasons, Japan, the US, and Europe.
So we are exactly at 12 noon, and it's time to wrap up. I'd like to thank all the panelists for their time. I'd like to thank the American Finance Association, particularly Sheridan Titman, who had the great idea of organizing this panel and named it back last April. If only we had called it When Will Europe Default, Sheridan. But we came pretty close. Thank you very much, everyone. Thanks to everyone.